Hello students, this video is to help you understand why in this chapter we're learning different inventory methods and simple ways to understand them. So first, let me give you a scenario. Let's say we are still, this time we sell apples and we buy apples from our suppliers. As you know, prices for all the products in the markets will keep fluctuating. So let's say first we bought some 100 apples for $1 each. And then several days later, we decided to buy more. Now the price of the apples have gone up to $1.20. So we bought another 100 of those. And then the third day, we bought another 100 apples for $1.50 each because the price has gone up even more. Okay, so now customers bought apples from us, and this one customer bought 50 apples from us. So let me ask you, well, for these 50 apples that we sold to the customers, how much do you think they cost us? Now that our apples are a combination of $1 apples, $1.20 apples, $1.50 each apples, it is hard to pinpoint since apples look pretty similar, and when you mix them all together, we need a way to put a price for the apples we sold, basically. That's why people came up with these methods for Fifo, LIFO, weighted average, and specific identification. So these four methods. So so earlier we had an example of apples. So first day, let's say October 1st, we bought 100 apples at $1 each. October 2nd, we buy 100 at $1.20 each. And then October 3rd, we buy 100 apples at $1.50. All right, and then we sold October 5th. We sold 50 apples, and we sold these apples at $3 each to the customers. Now, this $3, pay attention, it is your selling price. This is how much you charge your customers, right? But we still don't know how much. Well, we have 3 prices to pick. Which price should we use to track our inventory and cost of goods sold for this sale? As you learned from chapter 4, when you sell products, you need to record the revenue and you need to record expense. So revenue would be calculated at your selling price of $3, but you need a price to calculate your cost of goods sold, right? So this is how these 4 methods work. 1, 2, 3, 4. I'll talk about specific ID first. So under specific identification, if a company chooses this method, they usually, first of all, they probably wouldn't use it for apples, but they would use it for some very unique products, such as the car dealership. When they sell a car, they know exactly which one was sold and they know exactly how much that one cost them. right? So, but let's assume we were able to figure out these 50 apples. We sold these 50 apples. It's from, the $1.20 pile. Okay, so let's assume that we know these 50 apples are from a $1.20 pile. Then your cost of goods sold, which by the way, I'm gonna call it COGS, COGS, will be, we said $1.20, and we sold 50 of them, so $60. This would be your cost of goods sold. And then how much do you have left after you sold it? Well, we had 300 apples. We sold 50 of them, so we have 250 apples left. Ending. So if you take a look at how much is left, well, you had 100 of them at $1, plus 100 of them at $1.20, plus 100 of them at $1.50, minus what you sold, 50 times $1.20. So in other words, you have or you can think, oh, I still have 100, the $1 I still have all of them, the $1.20 I only have 50 left, and I still have all the $1.50 apples. So it would be 100 plus 60 plus 150. So what's left is worth $310 of apples. Okay, so that's the specific identification method. Now, like I said, you would use this method if your products are very unique. For example, a art gallery, a car dealership. We wouldn't really use it for identical products like apples, like sodas. You get my drift. Okay, so now let's get into FIFO. So what's FIFO? FIFO means first in, first out. This method is the most widely used method. Now, FIFO is assuming. So notice that I say assume we sell the oldest products first. Notice I say assume. So imagine if we sell apples and customers would just pick anything. When you go to Safeway and you would just pick any apple that you feel like you want to grab, right? So the customers may not necessarily always grab the oldest apples. They would pick whatever looked the best. However, in accounting, since we need a way to do it, we're going to, regardless of what customers pick, we are going to assume that they took the oldest inventory. So what's our oldest inventory? Well, it's the $1 apples that we bought. So we're gonna think that when we sold the apples on August 5th, the cost of goods sold is 50 apples at $1 each, because that's the oldest inventory. We had 100, so it's enough to cover 50 apples. 50. And then after the sale, how much is left? Well, sorry, moving my notes. Well, ending inventory would be you will still have $51 apple left. You will still have 100 of the $1.20 apple left, and you will still have 100 of the $1.50 apples left. All right. So this would give you 120, 170, 150, $320 worth of apples. As you can see, just because of we chose a different method, it already looks, the cost of goods sold and any inventory are different from the specific identification method. And that is fine, right? As long as we pick a method and we stick to it over the years. So if we pick another method called the LIFO, LIFO is the opposite from FIFO. LIFO assumes that we sell the newest first. So what's the newest in our timeline? Well, the newest apples are those at $1.50. Therefore, the cost of goods sold using LIFO would be 50 times, since we sold 50 apples, $1.50, because that's our newest inventory. It gives you $75. And what's left? Ending inventory is the dollar apples are still out there. The $1.20 are still there. And $1.50 apples, you have 50 left. Bought 100, sold 50, have 50 left. So 100 plus 120 plus 75, 220 plus 75, that's 295. All right, so that's LIFO. Now, on to the very last method, weighted average. I'll try to make it smaller. Okay. Weighted average, as the name suggests, we're going to take an average. So step 1 for this method is calculating an average price. So step 1, per unit, cost per unit. It will be the total dollar amount divided by the total units. So all your apples divided by the quantity. 100 plus 100 plus 100. So on top is the dollar amount, the dollar value. The bottom is the how many apples we have. And this would give us, bring in the calculator. So we have 100 plus 120 plus 150 divided by 300, 1.23. 1.23. And then you would calculate, you go on to your step 2 to calculate your cost of goods sold, $1.23 times 50 apples that we sold. $61.50. And then your ending inventory, meaning what's left in your inventory, is $1.23 times 250 apples that's left. So that gives you 307.5. All right, so that's the 4 different methods. Well, the weighted average would assume that you just you sell products at an average price. So assume average price. Now, again, in reality, people could grab any apple they want. It could be any price apple they happen to pick. So these are really just accounting assumptions. And usually, if a company picks a method, for example, FIFO, they need to stick to FIFO year after year, unless they have a really, really good reason to change it. And if they do decide to change it, they have to explain it on their financial statements, and they would have to do extra calculations to show the impact of the change. All right, and the most popular one is FIFO. And there you have it, the basics of the inventory costing methods.